Welcome to This Week in Money. I'm Jim Goddard. Today, oil and gas investments bulletin publisher Keith Schaefer explores the fallout from the unexpected collapse of crude oil prices. Jordan Capital Markets President Shayne Nyquvest tells us about the need to reorganize Canada's junior markets to make them healthy again. We'll talk to Keith Schaefer right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer. He's the editor-publisher of the Oil and Gas Investments Bulletin, which you can find online at oilandgas-investments.com. Welcome to This Week in Money, Keith.
Thanks for having me, Jim.
Boy, interesting times for you when it comes to oil and gas, I would imagine.
My world has been turned upside down in a very short period of time. I can hardly imagine that the first half of 2014 was amazing and the second half was a disaster.
The big question everyone is asking, will the prices for crude go down even further, and how long will these low prices last?
You know, that's a great question, and here's what I'm seeing. I'm seeing that, in my mind, oil actually wants to trade up. When I watch it going hour by hour, when I look at the longer-term picture of crude here over the last year, I think oil still has a ways to go downwards, but watching it tick short-term, I think it wants to trade higher. And honestly, Jim, the stocks are telling us it's going to trade higher, maybe not right away, but it's just interesting to see how many oil stocks are actually putting in good double bottoms and starting to move up a little bit. And with hardly any negativity, which means like the momentum sentiment on these stocks is turning positive. So it's a real conundrum right now for investors because oil does look like it wants to trade a little bit lower, but oil stocks look like they don't want to trade any lower.
How do you make any money in a market like this?
Small bets, Jim. This year is going to be about all small bets. There's so many different cross currents in the energy markets, and the energy market is kind of reacting to lots of different things. So I think you really want to just, whatever you do to make money this year, don't go all in. Don't just jump in with both feet. You want to just be cautious and see how it goes.
What do you see for commodities in general?
Well, I think oil and gas are going to be a tale of two different commodities right now. I just see the supply-demand picture for oil being a little bit brighter than most people think. I think demand is actually in very good shape, and supplies are actually a bit tighter than what the market is saying. But right now, all the derivatives and the financial action around oil are really just creating this washout condition right now. You know, Jim, we have, over the last 15, 20 years, as the world population, increased our demand for oil about 1 million barrels a day a year. That's been so steady, just unbelievably constant. And 2014, our demand was actually higher. It was about almost 1.5 million barrels a day more. And in 2015, we're scheduled to be just under 1 million barrels a day. So, increase in demand. So, there's no problem with demand. So that makes me pretty positive that given the natural declines in oil fields, especially these new shale ones, that the oil price has to go higher, probably even later this year. But for sure, right now, there's a lot of oil around, and until the Americans show that they're willing to cut back quite a bit, we're going to be stuck down here for at least another 3 months, I think.
Has the death of the Saudi king affected things?
Well, again, there's a lot of theories out there. Right now, the market is saying pretty straightforwardly it's not going to be a big deal. Oil did not spike. You know, if this would have happened in any time between 2004 and 2008, or even up to 2011, that would have caused the market oil price to spike probably $10-15 a barrel. Now it's completely shrugged off, because the Saudis have done a little bit better succession planning than I think most people have expected. But, the oil minister is staying the same. I think the street is underestimating a little bit the potential confusion and mayhem that may occur because of this. And mayhem is too strong a word. I just think the street's too complacent about what could happen here. So I think the next 6 weeks could be quite interesting, depending on how the internal politics go at in the Saudi kingdom.
What are the large and small drillers likely to do facing these prices?
Oh, Jim, there's no money being made here. These guys are getting squeezed really, really hard. The big guys can afford to drop prices a little bit, and the small guys, they're going to be forced to lay down their rigs. They're going to be, we're already seeing contracts being canceled. So companies that got nice big fat contracts for 2 or 3 year commitments for new drills. Those guys are having their contracts canceled, and so these small companies, they have to lay off people. Obviously, the bigger size you've got, the more ability you've probably got on your debt line and everything to survive these low prices. But it's going to be ugly for everybody. But the little guys are going to get hurt worse.
I've heard one of the reasons why North America can't turn off the taps or make them tighter like the Saudis can is that we have over 1,000 different companies involved. And how do you get them all to agree to just cut back production a little bit to bring the prices back up?
Absolutely. That's obvious. Yes, true. Yeah, agreed. But it is funny how the industry does tend to work as a whole. Like the oil price did get hit with a hammer, like a big ball peen hammer. So it's not like someone's not feeling pain right now. So even though there's 1,000 or 2 companies or whatever it is, they're acting in unison quite a bit. Maybe there's just different shades of gray right now as to how much they're cutting production.
And of course, you have to be careful of anti-combines action as well. If everybody acts together, the U.S. government may decide you're being a monopoly.
No, that's not an issue, Jim. We're nowhere near that much of a colossus or a one-phase thing. We don't need to worry about that.
That's just the conspiracy theory in me, that's all. Will LNG be the savior of BC, or is this too risky to say right now?
Oh, well, I think these LNG projects will go ahead for a couple different reasons. One is that right now, the oil price and the gas price are about the same on a BTU basis. There's very little difference between them. So that's not good. You want higher oil prices that makes everything else look competitive. But these things go in cycles, Jim, and all these big companies know that. So right now we're in a situation where, okay, oil price was incredibly high compared to gas for a few years. Now it's almost even, but that situation will come back again. Oil declines a lot faster. So I think that these companies have a longer term horizon, even though in the short term the game has changed. And you remember one other thing, Jim, these assets aren't going to be built for at least 4 years. Nobody has a clue what the market's going to be like in 4 years. So you just kind of have to go on past cycles. And everything says these things will last for 20 to 30 years, during which point there'll be enough high points in the cycle to make a bunch of money, but there'll also be a couple low points where all you're doing is breaking even. And we're kind of in that right now.
Australia has these giant production ships offshore doing their natural gas. Could you do that in BC with our totally different kind of coastline?
Well, those ones are actually way out in the ocean. So far, I think that they're about 175 miles off the northwest coast. So, here you've got the Hecate Strait up north, and where the continental shelf really comes up quite high, and you get some of the biggest waves in the world there. So you will not see any kind of floating LNG thing like that up around the BC West Coast. It's just different. The continental crust is different that way. It's actually relatively shallow water for being that far out in the ocean. But here where we are, Jim, it would truly be a nightmare.
Has LNG done a lot better job of laying the groundwork with the people who would be affected by their pipelines?
That's a tough question to answer, simply because a lot of the environmental groups and the First Nations just have this kind of binary idea that oil bad, gas good. And so I really do believe that even though natural gas has had a much better go of it politically and logistically getting built, that when push comes to shove and the shovels start to go in the ground to get these things done, that you're going to see some more opposition to it. And I'm a pretty big believer. You're seeing different groups like Tides Canada here in Vancouver that are supporting through quite generous financial means different environmental groups, First Nations groups, who will be ready to potentially oppose these things once they get going. So it's had a pretty easy go to date, but I'm not convinced that once the rubber hits the road, they're going to have the easy road they've had so far.
Well, I find it interesting that in Vancouver's and in BC, they protest pipelines. In Seattle, they're protesting that they're moving oil by train, and they want pipelines there because they're safer. Do you see any kind of disconnect or a place maybe where people can talk about, let's talk safety?
I hadn't heard that, but that makes total sense. Obviously, new pipelines are the safest way to move any kind of energy commodity. Old pipelines would be bad, and rail would be even worse. So, again, you're seeing a little bit of a double standard here in the protests. These Canadian protesters really should. I'm not sure what they're after. If they're after some solar utopia, and of course, who wouldn't want free solar power? But the economics just aren't there yet. So we've got what we've got, and let's make it as safe as possible for everybody concerned. And that generally means new pipelines.
It's going to say, yeah, free power. How come solar's so expensive?
So its time will come, I'm sure, and I'll start a newsletter on solar-powered stuff when it's ready to go. But until then, oil and gas is what we've got.
Keith, you were mentioning you have a special offer in connection with your newsletter. What's the special offer?
Well, Jim, we've as I said earlier, we're seeing right now in the market that stocks are outperforming oil. So oil stocks are outperforming oil the commodity. And so when that happens, when stocks lead commodities at the turn, that generally means it's not very long before the commodity is about to change as well. So we've got a special report that has the 3 top juniors in Canada that have the best leverage to a rising oil price. These are companies that have the best management teams in the business, who have been able to secure the lowest cost properties, and are not only going to be able to be the best survivors in a low price environment, but the stocks that move up the most and the fastest when oil really does make that turn. So we want to offer that to your readers risk-free at our website, www.oilandgas-investments.com.
That special offer is available from now until January 31st, 2015. Look under the player next to Keith's name. Click on the special offer link. Keith, thanks a lot for being on the show.
Jim, grateful you had me on. Look forward to speaking with you again soon.
Keith Schaefer is the editor-publisher of the Oil and Gas Investments Bulletin. You can find it online at oilandgas-investments.com. Coming up, Shayne Nyquvest on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
On the line from Vancouver is the president of Jordan Capital Markets, Shayne Nyquvest. Shayne, welcome to This Week in Money.
Well, thanks for having me, Jim. It's a beautiful day here in Vancouver, and thanks for having me on.
Today we're talking about the junior markets in Canada disintegrating. It's all over overregulation, lack of capital, and the market downturn. Market participants are looking for junior markets that can benefit greatly during the next upswing, though the underlying regulatory structure of the junior markets is a big concern. Just why are the Canadian junior markets being called a predator's market?
Well, I think there's a lot of reasons for that, and obviously we're in a commodity cycle downturn. That's not a big secret. Oil's probably been the last shoe to drop here. Uranium fell from 142 to $27 a pound, and that kind of went unnoticed, and copper's fallen off, and a variety of other things that probably started 2-3 years ago. So hopefully there's some basing on some of that stuff now. Gold seems to have found a base, and possibly there's some upside from here. But there's some fundamental problems as well in the venture markets and other markets that are complicated by the commodity cycle, and the commodity cycle's not the only reason for the lack of pools of capital that we have become used to in what used to be known as the venture capital of the world and the venture mining market of the world, being Vancouver. So, you can start with the crash of 29 and the advent of the Bank Act somewhere later in 1933, which prevented banks from owning brokerage firms, insurance companies, and trust companies. The asset-backed disaster in the U.S. was obviously a conflicted problem between banks, insurers, But it all started from deregulation in 1985. 1995, there was close to 35 brokerage firms in Vancouver. You now have 8 or 9 independents, and it's probably on its way to 3 or 4. Bank asset gathering and administrating of funds at a perceived low fee, involves conflicted products. What's the next disaster? I don't know. Maybe ETFs, but that's a macro picture. It's not something that's going to change anytime soon, and that situation will play itself out over time. How do we make the best of a tough situation now? You've got problems with uptick rules. To their credit, there's been a few changes made, but there's a lot of changes that also need to be made in order for the public to perceive a level playing field again. Exempt purchasers have been dwindling in the last 3 years, based on, capital deterioration in a variety of areas. And, that does not provide for a level playing field. Risk and wealth creation are a big part. You don't get to wealth preservation and wealth management unless you've got a wealth creation capability. So how do you make those markets perform best for what they were designed to do? The markets were designed initially to take people with pools of capital, distribute them amongst larger bases of people, i.e. a share offering, and allow those people to participate on a level playing field to create larger pools of capital, create the Ford and General Motors of the 1900s that drove the economy in the U.S., to the Microsofts of the 70s, to any business that needs to be financed needs a capital pool to be able to tap on. That market needs to have a semblance of a level playing field. When you've got uptick rules, illegal shorting by gangs of large predator capital pools, there should be some simple fixes to it that have become very complicated based on high-frequency trading, highest optic fiber. How do you get to the market within a nanosecond faster than the next guy? All of those things are not what the market was created for to begin with. So, how do you get back to basics and put a level playing field together that is fair for the public and allows people to create the types of businesses and industries that we're looking for in the next decade to, create jobs, spur growth, and provide value-based companies and investments, is where the regulators and participants in the industries need to step up and be accounted for.
Germany has banned short selling. Their attitude is you're here to raise money for business. You're not here to bet against them. Would it be a good idea to get rid of short trading?
Well, short trading, every time there's a crisis in the New York market, for example, the last time all of our assets froze up and the banking system basically collapsed, which again was, in my opinion, a function of eliminating the 4 pillars of the economy and allowing banks to be cross-pollinated with insurance companies, brokerage firms, and conflicting industries. So how do you fix that? Well, you got to macro address the problem, but every time there is a freeze up, the uptick rule or not allowing shorting altogether is the first trigger they pull to, avoid a crisis. Nobody's saying you can't short a stock, but in order to short a stock, you should be putting up your money like the rules of short selling are, not allowing gangs of predator funds to sell into a bid and continually pummel a stock for predatory purposes. That's not the function that a market should provide. That's just a way of vulturizing people's funds for no particular purpose other than greed.
How are high-frequency traders hurting the industry?
Well, as I just described, if there's no rules and regulations on short selling, if you can hit a stock on bid and illegally short it and keep shorting it, it's not that hard to drive the price of a stock down. So if a company comes out with a news release and predator funds are allowed to continually pummel it into the ground, and the shareholder that reads a positive news release, which is what inspired them to that trading volume to begin with, and continually pummels it, and it ends up down, and he reads a news release and he says, geez, I thought that was good news. I guess I better sell. That just hyperventilates the problem. It's a pretty easy solution to the problem. You bring back the uptick rule, which says you cannot sell a stock that you don't own unless it's on an uptick, and you've got proper margin, to offset it. So a lot of common sense and a pretty easy fix if you get right down to it. Why you wouldn't fix it has got to be a conflicted answer. Somebody's making a bunch of money, and that somebody has got some interest in, how the rules and regulations are played out. In other words, there's a huge conflict of interest there somewhere.
Do the plethora of trading platforms harm the business as well?
Well, why you need half a dozen different markets and high fiber and be able to get to a trade in a nanosecond faster, really is beyond me. I think the biggest mistake was trading platforms being created for profit. The markets used to be created and owned by the members and the participants who wanted to exchange interest in companies and create liquidity. There's a number of other factors come involved, hedge funds and, hedging the price of oil, hedging, pre-selling, variety of products that are extremely confusing but are also extremely conflicted, don't really allow for the real purpose of the exchange, which is to finance companies that are going to lead us into the next decade and increase the quality of life.
Do the laws governing the markets favor predators?
Well, obviously they do. If you can sell a stock from a variety of large pools of capitals and drive it down without having to put up margin, without selling on an up, which is the standard procedure in any short sale, then obviously you've got a huge advantage and a non-level playing field. Investors are staying away in droves for that reason and several others. So fix the problem, drive on, create a level playing field, and as things improve and as, investments in companies are made that create positive results are jobs, industries, that benefit society and benefit the investors, you're going to get more interest in investing. If you don't have a level playing field and you feel you're at a disadvantage to investing in a company that is able to be illegally shorted regularly, why would you play? And that's what's happened. That proof's in the pudding.
We'll have more with Shayne Nyquvest next on This Week in Money.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to Shayne Nyquvest, president of Jordan Capital Markets. Shayne, a lot of people have compared the junior markets to the junior hockey franchises that are an incubator for the NHL. Do the junior markets work the same way for the major equity markets?
Well, of course they do. You're going to, and I'll give you an example. There's a diamond industry that now exists in Canada that in the 90s didn't exist, and it wouldn't have existed if there wasn't some risks taken based on good geological theory, and you created an industry that is now 15% of the world's supply, $15 billion a year, and probably 8,000 jobs. And that wouldn't have been created if it wasn't for the availability of formations of capital pools, and we're talking about risk. We're talking about not wealth management, we're talking about wealth creation. And everybody and every person that starts without a wealth capital pool, it needs to have a fair shot at creating that wealth management or that wealth capital pool. Bill Gates, started with nothing and created an industry that has changed the world with technology. And that was created, through pools of capital that were available to prove those theories. And any junior market is going to involve risk. Casinos in Vancouver apply the theory, know your limit, play within it. When you overregulate and say only exempt purchasers and anybody over a certain age is not capable of creating their own wealth of intelligence, it defies logic. So, you need a level playing field. You need pools of capital available to create fair treatment of shareholders. Rights issues, for example, are an absolute no-brainer when it comes to treating investors fairly and giving them comfort of a level playing field, because every existing shareholder is allowed to participate in a company that's possibly been restructured, possibly been rolled back from 100 million shares because whatever the previous risk was didn't work, but the investors left with a second chance to participate in another project that's come to light and has been created with the best people available and the best minds and available in the industry to present this opportunity fairly to investors who want to know that they're playing on a level playing field. So to answer your question as well as possible, you can't have a major league if you don't develop the minor league, and the minor league is taking risks with people's capital on a level playing field.
How can the government help get the junior markets back on their feet?
Well, the junior markets in this part of the world, if you want to talk about national regulators and all that, we can get into that too. But, they've been trying to implement a national regulator here for as long as I can remember, and I've been in the business for about 30 years. I started with Canaccord, which was a dynamic company that was built on the basis of, some good investment minds and bringing and delivering the best opportunities available to investors. And I think there was a lot of wealth created during that period. That period is not changed. There's still a number of businesses, tech businesses, mining businesses, whatever, that need access to capital pools. That's the whole basis of free enterprise and democracy. So governments can mostly help by staying out of the way. The LNG business and trying to focus on that. In the meantime, you've had a spin-off mining business, which, yes, has been in a consolidation phase from a commodities pullback, but it's also got some structural problems that have been brought in through increased regulatory environment that is prohibitive to costs of being public need to be reduced. Levels of disclosure need to be prorated and pro rata based on for example, and to give credit where credit's due, bringing in 10-for-1 rollbacks without shareholder meetings on companies valued at less than $5 or $10 million. You're not going to roll back TELUS without getting a shareholder's vote. But to roll back a company that nobody's going to show up for a meeting for, spend 75 or 100 grand in mailings to, restructure a company so it's got another chance and those investors have another chance through a fairly designed rights issue is common sense. So let's get back to getting those companies relaunched, restructured, refinanced, and in any economic downturn, which we've had since the asset-backed disaster, brought on by the evaporation of the pillars of the economy, and, deliver a fair playing field, not over-regulated to death, standardized forms, and, governments can help through flow-throughs. They can help through capital gains on a larger scale. Countries invest same as investors do, but they do it on a different scale. Government politicians, in my mind, are not the best people to be creating jobs and, determining which businesses or which industries, should get priority or capital assistance. The people in those industries should be allowed a playing field to develop them and get government assistance, not government interference. The mining business in Western Canada and oil and gas probably throws off north of $800 million to $1 billion worth of spin-off benefit to legal firms, accounting firms, whatever. But they're not the main concept or the main beneficiary of what these funds are raised for. They're raised for people who develop the Microsofts of the next decade, the Fords, the General Motors, the next concept that will create jobs and provide improved quality of life for all of us. Those industries, if you're going to take down the four pillars of the economy, you may as well let banks acquire accounting firms and legal firms as well. Then they can cover their tracks and never have to go to court, because these industries need to be regulated from within, and they need to be separated. Citibank's the largest bank in the world, and I've heard conversation of them looking back to separate their brokerage firms, insurance firms, and allow them to be regulated, individually. It's a really simple equation. Any 35-year-old president who's trying to meet his dividend requirements or his capital, growth requirements is going to use any advantage that he can. And a small example would be if an insurance company buys a brokerage firm, chances are whatever insurance product they now have in place is going to be changed to the company that's just bought an interest. That's an example in a very small way of the conflicts that get created. Governments need to provide a level playing field, equal opportunity, and, allow pools of capital to be created and risks to be taken. There's risk in every part of life. Walking across the street is a risk. So to risk your money in a level playing field is not something that people are going to be adverse to. They will be adverse to large predator funds being able to, clip markets for profit that aren't adding anything back to the economy. Here's a long-winded answer to your question, and I hope that hits the nail on the head.
Do we need a national regulator? Some people have expressed concerns that a national regulator wouldn't reflect regional interests and would be Toronto-centric.
Well, as I've said, in my 30 years in the business, this national regulator has been brought up, I don't know how many times. But the biggest problem in a national regulator is the problems and the requirements for oil and gas in Newfoundland or potash in Saskatchewan or mining in BC are different requirements. Industrial growth in the center of the industrial growth, which is probably Ontario, are different than the concerns required by a Vancouver mining firm that need to be able to access capital on a fair basis to the costs involved. The costs to regulate and mandate major corporations and big industries are different than what you need for a venture capital market. In other words, the minor leagues to exist and thrive. Investors are there to participate in the growth of various industries and are prepared to do that if they think they're on a level playing field. If they don't, they're not going to bother, which is, a lot of the deterioration that you're looking at today is for a variety of reasons, not just an economic downturn and a commodity cycle collapse. There's fundamental problems in the regulatory environment that don't let an investor perceive a level playing field, and he's not going to come back until it is. So governments or regulators are going to either recognize this or they're not going to be in the next government.
We'll have more with Shayne Nyquvest right after this.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Shayne Nyquvest, president of Jordan Capital Markets. Shayne, how do other markets compare with regulations?
Well, I guess, history tells us a couple of things. If you go back to the early 70s, mutual funds were the scourge of the business. They were the car dealers of that decade. And at that point, mutual funds became a very conflicted product, fell out of favor, and, were regulated. In today's new market, if you will, you've got a variety of products. You've got a variety of people who call themselves money managers. You've got more mutual funds than you probably do stocks. You've got ETFs, which provide a hedge against just about everything. And my concern is a lot of these ETFs are backed by less than 5% of the underlying commodity or asset that they're selling. So if you go back to the asset-backed disaster, it was created by banks and brokerage firms creating products, insurance companies insuring those products, and at the end of the day, it was nothing more than a game of musical chairs, and somebody ended up holding the bag. That somebody was the investing public who saw real estate prices in the U.S., dramatically cut in half. You want to compare it to the ruble's collapse right now, it's any way you cut it, it's a deterioration of wealth of a country that was created by conflicting industries creating products that really didn't provide any substantial basis. And all of those investors thought they were buying AAA mortgages when in fact they were buying something like double Ds. So how do you prevent that? You bring back the pillars of the economy, regulators do what they should do, and you have products that go back to the whole basis of capital pools being created, which is to invest in companies and provide access to people with good ideas to create the next Microsofts of the next decade. So that's the best regulatory reform that I can give you. Make funds accessible without overregulation and excessive accounting requirements, legal requirements, and come up with a series of regulations that protect investors, but also protect them from predatory pools of capital that do things like illegal shorting and create products that really have no benefit other than, vulturizing or preying on the capital markets of the world. If you look at the casino market of the world, there's no regulatory involvement there, but it's government-based. They benefit from tax revenues, and it's an industry that provides benefit, but regulation is completely gone. You can pull up with your trunk full of money, leave when it's gone, and the regulation is know your limit, play within it. Now, that's oversimplified, but then you can take the investment markets and tell a 65-year-old guy that he's not an exempt purchaser and he can't play, where he probably has more benefit, more knowledge, and more to bring to the table than anybody else in the industry. So, to have funds managed by fewer people and larger quantities is not necessarily a good thing. Your perception of what you're buying and what the risk of that product is, although you're calling it managed money at 1%, if it's full of all kinds of conflicted products that really aren't 1%, and you really aren't certain what the risk is, people are happy to take a risk. They know what the risk is. In the asset-backed disaster, they had no idea what the risk was because they were advised that it was one thing and it turned out to be another. How many of those other situations exist, and how that relates to access to capital and level playing fields, are the issues that need to be addressed. We all know the problems. There's no point in continuing about what the problems are. The solutions, and how do you give the confidence of a level playing field again, is through things like bringing back the the uptick rule, eliminating high-frequency trading, standardizing forms so that when you open a brokerage account, you don't need to disclose your insurance products, reinforce the Bank Act, and have industries aligned through the pillars of the economies that they were designed for. Prevent confliction or conflicted industries wherever possible. Make a level playing field exist, like rights issues, and governments can help through capital gains exemptions or flow through funding. And then the best thing they can do is stay out of the way. They're not the oil or the finance or the corporate executives who have the knowledge in them. You're there to provide regulation and let the people within those industries thrive. Stay out of it, provide a level playing field, and encourage the industries of that particular region. I'm not sure a national regulator can provide that across the playing field for all. There's different requirements in every different area of growth.
Citibank is talking about spinning off some of its businesses. Is that a template Canada should look at?
I think reinstating the four pillars of the economy is either going to happen by common sense or disaster. 1929, it happened by disaster. They brought the Bank Act in response to the problems that existed in the crash of 29. Banks were loaning money with 80% margin, and that was a recipe for disaster. History has a habit of repeating itself, and the human condition is such that history is probably the best look into the future. Why continue to make the same mistakes? Fix them. Citibank's splitting its investment business from its banking business, from its insurance business, goes back to adhering to the pillars of the economy and the Bank Act of somewhere around 1933. Don't quote me exactly, but that, created industries that were regulated from within and less conflicted products.
Vancouver's known as the junior mining capital of the world. What can we do to make sure we don't lose that title?
Well, again, provide a level playing field that investors can participate in, provide capital structures that are streamlined and efficient so that you're not raising, 40% of the capital going to pay for overregulation, legal, over accounting fees, and make sure that 95 cents of every dollar is going into the project that you're financing. Make reporting requirements, suit the company. The reporting requirements for Imperial Oil would not be the reporting requirements from XYZ oil and gas company that is, starting a junior business. Markets need to reflect that.
Shayne, apart from all the things that you've told us that you think should happen, if you were king for a day, what do you think you could do to make this thing work?
Well, that would be delightful. But I would reenact the Bank Act. I would, make industries separate. I would lessen government involvement in businesses, make them more of referees in a hockey game, if you want to compare it that way. I would reduce the regulatory requirements. Regulations should fit the investment. I would provide a level playing field for investors to feel that they had a fair shot. The uptick rule, illegal shorting, none of those things are value added or in the theme of why stock exchanges exist. Stock exchanges, to me, should not be profit-based entities. They should be a forum allowed to have its investors or its members trade interests in companies in a fair, well-regulated, fairly regulated, not over-regulated arena. It's where the hockey game takes place. If you want to relate it to Canadians that can understand that. I'd love to hear from all of the regulators. I'd love to hear from a government, perspective. I'm sure they have problems that maybe we don't perceive. We'd love to welcome them to the table because the basis of a free enterprise and an economy that works is when all facets work together. So I'm sure they have other problems that maybe we don't comprehend or understand. We'd love to hear them, and we're all here to work together and create a conducive environment for investment, economic growth, and fair and level playing fields. Is a continued advantage to trying to move the capital markets in this country forward and find more capital for people that deserve that capital to grow their businesses. Thanks for your time today, and I look forward to continuing to listen to your show.
Thanks, Shayne. My guest has been Shayne Nyquvest, president of Jordan Capital Markets. Their website, jordancap.com. That wraps up our show for this week. Thanks to our guests, Keith Schaefer and Shayne Nyquvest. And thank you for listening. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.